Ladies and gentlemen, welcome to the Q2 FY21 earnings conference call of Monte Carlo Fashions Limited, hosted by Emkay Global Financial Services. We have with us today Mr. Dinesh Gogna, Director, and Mr. Sandeep Jain, Executive Director. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Devanshu Bansal from MK Global. Thank you, and over to you, sir.
Good afternoon, everyone. I would like to welcome the management team of Monte Carlo Fashions Limited on behalf of MK Global Financial Services and thank them for giving us this opportunity.
Dear friend, the management team includes now Mr. Rishabh Oswal also. He is also Executive Director. He has just joined.
Sure, sir. Welcome, sir.
Welcome, Mr. Rishabh Oswal.
Mr. Rishabh, welcome to the call.
Thank you.
I would now hand over the call to the management team for their opening remarks. Over to you, sir.
Very good afternoon. It's a great pleasure to welcome you all to this earnings conference call to discuss our financial performance for the second quarter and a half year of financial 21. Thank you all for sparing your valuable time in joining us here today. Before sharing the recent developments and strategy undertaken for growth, let me provide the key financial indicator reported during the Q2 of financial 21. Revenue during the quarter stands at 98.2 crore as compared to 152 crore in Q2 of financial 20. The company reported gross margins of 60.4% in Q2 financial year 21. Operating EBITDA margin during the quarter stood at 15.2 as compared to 13.2 in Q2 financial 20. The cotton segment now contributes around 41.7% of total revenues as reported in Q2 of financial 21. The t-shirts, shirts, denim jackets forms a major share in cotton products category. Home textiles segment continued to grow at a healthy rate. Home textile segment contributed approximately 35.2% in Q2 of financial 21. The company's performance during the quarter was encouraging. With the lifting of lockdown in most parts of the country, the company was able to operate its manufacturing facility at Ludhiana successfully. The company remained focused on stimulating the consumer demand with various strategic tie-ups while maintaining the focus on restoring the lost ground due to COVID-related disruptions. Our operational profitability and the cash flow stabilized during the quarter while we maintained strict control on the operating costs. One of our key strengths has been our wide and growing distribution network with a holistic presence across India. We have a deep presence across India through 2,500 plus multi-brand outlets, 25 EBOs and 279 national chain store outlets and 146 shop-in-shop. Majority of our revenues comes from MBOs and franchise EBOs where we primarily sell on pre-order and outright basis. By virtue of this business model, there is no major inventory risk and we remain adequately protected from the normal hazard discount sales in the branded apparel business. We have strategically eyed for increased revenue contribution from online sales and I'm happy to share that the increased traction from this channel, online sales from Q2 financial 21 stood at 7 crore against 6.7 crore during the same period last financial year. As per our growth strategy, we are building our pan-India presence with current emphasis on western and southern region. We have already made an encouraging beginning towards this goal. To increase the reach of Monte Carlo product to the end user, we also have a strategic tie-up with AGO, FirstCry, Tata Click, along with our existing tie-ups with Amazon, Paytm, Flipkart and others. Monte Carlo continues to enjoy a comfortable net cash position and its medium-term liquidity needs are well covered. With adequate banking limits in place, its ability to service debts and financial obligations on time remains unaffected. Monte Carlo has zero reliance on exports and has a presence in domestic market across India with an extensive distribution network. The good credit terms with our supplier help us to operate the business smoothly. The no major capex is planned for the next 2 financial years, thereby positive operating leverage expected as the production gains scale. We are strongly focused on optimizing asset utilization, quality, efficiencies, and relationships. Before we open the floor for question and answer session, I would like to wish everyone a very happy and a prosperous Deepavali. If you have any questions or queries still unanswered, you can reach to our investor relation team at Dickinson World. We now open the floor for a question and answer session. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Zakir Nasir from an individual investor. Please go ahead.
Hello.
Good morning.
Sir, good morning. Wishing all of you at Monte Carlo also a very happy Deepavali. And let us hope this year is great for the country. Sir, my first question would be, sir, since it's already 1.5 months into your prime season, this is a quarter where Monte Carlo does most of its top line and bottom line. How is it looking, sir? Do you think it can compare with the previous winter for you? Point number 2, one thing I noticed is that in this current 3 months, the purchase of stock in trade is quite down. So majority of the sales would be from our own manufacturing. Is that correct, sir? Thank you.
Yes. First, we'll come back to your first question, which is you asked about how this winter season is going as compared to last financial year. See, well, if we see the sales of October, and if we compare with the last year, we have reached almost 90% of pre-COVID sales as we did in last year. So that is the status of EBOs. As far as MBOs and SIS are concerned, still we have to get this data from that channel, but we believe that they have also at par what we achieved in our retail outlets. And your second question was, own manufacturing will contribute more or the outsource manufacturing? Yes, this year definitely I think there will be little more contribution from the own manufacturing, as the unit number 1 where we make sweaters. Basically, we don't see a much fall as compared to the last year's level, but definitely in the case of the goods which are manufactured outside, like kits, where there have been labor shortages, and we have also reduced production as compared to last year. So there will be proportionately the in-house manufacturing will be more as compared to last year's level. So the season has started well for us, and of course there has been less fear in the minds of consumer as compared to the last quarter, where people are not venturing out of their homes and they were not going for shoppings, and they were not like going on high streets where we have most of the stores located as far as EBOs are concerned. So we are very positive to begin in this quarter.
We're expecting the winter quarter to be at least 90% of last year kind of stuff, sir.
No, I have told you the October sales have been 90% of last year October sales. So November and December sales are still to, and we believe if the second wave doesn't hit us very badly, I think we should have the same levels in November and December as well.
Fantastic, sir. Thanks a lot and best of luck, sir.
Thank you. The next question is from the line of Gautam Gupta from Nine Divorce Capital. Please go ahead.
Good afternoon, sir. Thank you for the opportunity. Great to see us emerging, I think, from the worst of the COVID patch. I think things are going exactly the way you had envisaged in the previous quarter, previous couple of quarters ago. My question, since we have Rishabh on the call as well, my question will be on the e-commerce side of things. So, we are still quite small in terms of sales, and obviously we are growing and investing a lot in that. It would be good to get a broad roadmap for e-commerce. I'm not looking for guidances or targets, but more in terms of, where do we size the opportunity in the long run? And where are we in terms of our reach, in terms of cataloging, visibility? Where are we? Where do we want to get there? So just to get a broad picture on the e-commerce side.
Okay, I would ask Rishabh to answer this question.
Hi, good afternoon. So thank you for the question. During the lockdown, as already mentioned in the opening speech, we maintained the sales figures of last year. And this year in the winter, we are targeting a 25% growth in the online sales segment while doubling our own website sales. So the key focus for this year is focusing on our own website where we enjoy extra margins also. So that is the way going forward. Also, all our advertisements focus has been shifted towards e-commerce sales. So we are focusing more on social media and Google AdWords to direct more customer to our own website.
Okay. So if I may ask...
I would like to add one more thing.
Yes.
If we see, it's only the online channel which has grown in this financial year. Otherwise, all other channels have been down.
Yes.
If we compare the sales growth.
So Rishabh mentioned that we are focusing more on our own website sales, which is fantastic. If I look at H1, ballpark, how much of the sales would be our site versus third party? Broadly.
We currently don't have the exact figures for our own website per se, but we'll share
you
it
think it
with
will be less than half? If the numbers are small, so I don't need the exact number. It will be around half, less than half, or maybe we can come back later if you don't have that.
Yeah, I think it's better we'll come back later.
Fair enough. So we said 25% growth is what we are seeing this year, and doubling our own website sales is our aspiration. But from a longer perspective, maybe a 3-4 year perspective, do we still look at something like, again, I don't want guidance, I'm not going to hold you to it, but I just want to understand the aspiration and where you size the market. Is it a 25% CAGR in terms of the market size, or is it a 50% CAGR? Is it something that we can double in 3 years or 4 times or 5 times? In terms of the size of the opportunity, because Monte Carlo is a brand which is not a mass market brand, it is not a discounting brand, it has its prestige and brand value. So from that point of view, I wanted to understand where you see the market opportunity in online. So I remember a few years ago, we said, the online market is more discounting, low cost, and maybe the opportunity for Monte as a brand is not that big. Is that changing?
Yeah, so I think to answer that question, if we see the discounting percentage in the online segment for our brand Monte Carlo, it's almost at par with the offline channels with an increase of 3 to 4%. And when we sell through third-party websites like Myntra and Jabong, we have clauses written in our agreement, but our ability to control the discounting is still dependent on them. So that is why the shift in focus towards our own website. And also we have started developing some special merchandise only for the online segment in order to avoid the clashes with the discounting when it comes to the offline channels. So in the next 3 years, I think we should be able to contribute 10 to 12% of the company's turnover from the online channel.
Fair enough. Thanks a lot for that.
Thank you. The next question is from the line of Venkat Subramaniam from Organic Capital. Please go ahead.
Hi, thanks for taking my question. A couple of my questions are fairly general in nature. Now that actually people find less and less reasons to go out, do you see challenge in branded apparel per se? And two, when Rishabh mentioned that about aspirationally we would have about 10 to 12% of company's revenue coming from here, that's almost about an 8-fold growth. So if you can kind of expand on what kind of strategy that we have to get that going. And I have a few more questions later.
See, I think answering your first question, where you mentioned that people are stepping less and less out of their homes, I think it was actually very true when it was we were in last quarter and from March to September. Definitely, people were and putting themselves to the homes. But as we have stepped into October and we have seen the COVID cases are coming down from approximately 1 lakh cases to almost 50,000 cases. So there has been a revenge traveling also. People are just, fed up sitting at home and they just want to go out of their homes and go for shopping, go for some holidays also. We have seen even the hotels in our nearby places in northern region in Himachal and all, they're fully booked. So as the COVID case have come down, people are just moving out of their homes, and in the walk-in in the malls have increased almost 3 to 4 folds as compared to September if we compare in particularly some of our malls. So I think this is a phenomena which will keep on going up because we were restricted to the homes for such a long time, so people will move definitely out unless and until there is again a crisis of increased COVID cases, which fortunately we are not facing right now. Of course, as in India, it's been happening in Europe and US and other countries, but you never know about how this moves, how this happens in next 15-20 days. And secondly, as you rightly mentioned that we are targeting a 10 to 12% of online sales, as Rishabh has rightly mentioned, in next few years. The reason being is that people are getting more and more habitual of purchasing online as compared to the past. Because earlier some of the people who were not actually buying online have actually gone online because they were not having any other option. Earlier they used to go to the shopping. So this phenomena I think will keep on happening and will keep on growing, and that phenomena will definitely help a brand like us to increase our sales in online channel, as well as we have a loyal customer which are not only purchasing online but not only purchasing offline, but they are moving to online as well when they know that it's difficult to move out of the houses.
No, we have no doubt that that's a direction that the market is taking. But in as much as we don't discount at all, because I'm noticing your presence in many of the popular sites, we have held on to our price point. So given our reservation about discounting, how do we get to that 10 to 12%? We know that is the direction the market is taking, but how will we get to about 60-70 crores of current revenue in current gross terms, or it can even grow higher later? How will we get there? That's really the question.
See, why we are mentioning this thing is that the percentage of discounting in overall sales is actually growing every year. Earlier, there have been a fresh percentages approximately 60% of the sales. But now the fresh percentages have gone down to almost 40% of the sales. So 60% of the sales is happening basically in the discounting end of the season sales. So at that time, the offline and online channels are offering the same discounts. So people have the option of purchasing online as well as offline. So people who just want to sit at home and order, so that will definitely push the online sales in discounting season as compared to offline sales. So that's the reason Rishabh mentioned that in the coming few years, we will see definitely the increased online sales, even if it comes from a discount, as far as the whole total channel is concerned.
Fair enough. I just have a couple of bookkeeping questions. Our home textiles seem to have gotten to a fairly significant portion of our revenue. How do we envisage on a near normal kind of a trajectory? What portion would you see home textiles going up to or maintaining? And two, I noticed that in East we have grown pretty well actually this quarter. And thirdly, your cotton percentage has kind of actually dropped. So on these three counts, can you kind of guide us as to what the steady state will be? Thanks.
Home textiles, as we mentioned, I think in last year also, that it is one segment where the competition is relatively less as compared to the garments. So that's the reason it's not that much affected from the competition as our other garments are. So home textile contributes, last year I think it contributed almost around 12% of the revenues. And this year it will increase. The reason being is that as the other revenue is coming down in garments, but in case of home textiles, the fall will not be that much. we anticipate the fall of around 25% in case of our other Monte Carlo garments in this financial year because of less production, because of COVID. But in case of home textiles, we see a fall of only 10 to 15%. So definitely the growth will be much more in the coming years as well. The another reason why the home textile is not dropping this year, the reason is that because home textile is normally in India, in particularly in the northern region, it's normally being taken in the gifting sales also. So as we have this beginning of the wedding seasons, people normally gift blankets, in our case Monte Carlo blankets in the weddings and other also as well, and that is mainly for in the rural region, not in the urban, mainly in the rural region. And the rural sales are not that much affected if we compare with the urban sales. So that is another reason it has not dropped as such the other Monte Carlo garments.
Sure, sir. Thanks a lot.
Thank you. The next question is from the line of Devendra Pandey from DB Financial Advisory. Please go ahead.
Good afternoon, and thanks for taking my question. So I have recently started to track this company. So I just wanted to understand what is our blended average realizations as of now and how the trajectory has been in the last 3 to 5 years.
I can let you know the NRV for this year as well as the last year. Yeah.
Hello?
Yeah, just hold for a moment.
Yes, sure.
See, if we see the net realized winter sales of autumn winter 19, it was approximately 50.53% for MBOs. If we compare to MRP sales, it was around 49.29% in case of EBOs and 46.78% in case of online. And it is mostly similar in autumn winter 18 also, where we have little lesser sales in NRV in online, which is 43.8%, but in MBOs and EBOs, it is almost equal.
Sorry, sir, I didn't get your answer. I was referring to average realization per piece for you, blended average realization per piece.
Okay, just a moment. Okay, in case of, if we talk about the men's sweater, the average realization in September 19 was 1453, and this year it is 1523. In women's, it was 1432, and this year it is 1379. And in case of cloak and leather, which is our economy segment, it was 776 in September 19, and it is 679 this financial year.
And what would be the difference between, just a ballpark number, the difference between average realizations through our own shops and through the online channels? Or would it be the same?
It's almost 4% as discounted, little more in online channels as compared to offline channels.
Okay. And what would be the trajectory going forward? Do you see this growing, or do you see the average realizations remaining at this level, but the number of pieces growing?
No, in case of online, I think the average realization will go up, as we have seen the trend that even the fresh sales are contributing now more as compared to discount sales, as people are becoming used to buy online also. So I think the realization in online channels will improve going forward, and I see that the realizations in the offline channels should remain same.
Okay, sir. Thanks. I'll get back if I have any questions. I will join the queue.
Thank you. The next question is from the line of Vikas Kimani from Carnelian. Please go ahead.
Hello sir, how are you?
Yeah, I'm good. How are you?
Bas all well. So Sandeep, ये बताइए अपना the key thing which I wanted to get a sense around. I mean, one is obviously this COVID, but our bigger problem is larger. If you see from last 2014, 15, 16, our sales have just remained quite stagnant. Okay, I mean they have not. I mean we were around 550, around in the range of 580 to 600 crore, and after almost 5-6 years, despite having such a strong brand, product recall, and the growth has just not come by, whereas most product categories have grown, and So what's your take? How are you, are you at all planning to address that problem, or what's your overall take on that? Because that's one of the reasons why company has taken such a beating on the market cap despite having such a good consumer-oriented company and strong return ratios. But the growth seems to be elusive despite, all being right.
I think there is a little misunderstanding as far as understanding the revenues are concerned. If we see the revenues in 17 and 17-18, it was around 575. In 18-19, it was 655, and in last financial, it was 724. The reason in last 3 years why the revenues have not grown proportionately as compared to 2014-15 and 15-16, because at that time the discounts were considered as an expense, and now we are actually reducing the discount part from the overall sales. So if we include the discounts as expense, the sale will proportionately go up from 2014-15 level and 15-16 level, because after that the method has changed. So now, as of now, we are reducing all our discounts from the total sales. But earlier we used to put as an expense, so the revenue used to look up. So that is the reason that if you see the growth from 2014-15 until 2019-20, it's not showing as that much. But if we compare the growth of 17-18 and 18-19 and 19-20, which is on the same method, in 17-18 the turnover was 575. It grown around 11% to 655. Again, it I think grown around 13% to 724. If we compare the last year, even though economy was not doing very well in last 2 financial year also, if we see the Indian economy was growing only at just 5% of GDP, we were outperforming the economy almost by double the rate.
Okay, so going forward, how do you see the growth coming back? What's your sense on the growth? What are the categories you think? I mean, if you can give some, this is nothing to do with the quarterly earnings. Obviously the December quarter, I'm assuming, will be much better than current quarter being the peak quarter. But in terms of trajectory, one has to say what will be your major growth drivers, and how are you planning? Can you share some of the strategy on that?
I think the major growth drivers going forward definitely will be our SIS, EBOs and online channels and modern retail, where we are penetrating and increasing our presence year by year. And definitely in the geographical expansion also, we are increasing our presence in West right now, where we are opening our exclusive outlets. Almost, I think this year will be adding around 3 outlets more in Western region. And then we are putting a lot of emphasis on the northern eastern region also, where we are opening our exclusive stores and increasing our presence in MBOs. Definitely we are a little weak in southern region, as we have not been able to penetrate that much in case of southern region. And the growth will definitely come from the existing categories and also the newer categories which we have added over the years, like a cloak and decor economy segment, and also our accessories which are increasing every year, and definitely the home textile segment which is growing almost double digit from last 4 or 5 years. So it's basically growth in the existing categories, growth coming from the newer categories, and also from the geographical expansion.
And in terms of your distribution reach, I think EBOs you give 2,500 plus number. So I mean, for last in your presentation also it says that same number plus. So is that the number not to be monitored, or I mean, why is that it remains as a number of 2,500 plus for last 4 quarters? So is that, I mean, it's just I was curious to
900.
Sorry.
The total sale points as of now, if we compare with the September 19, it was 2929 and it is 2895 in September 20, which includes our EBOs, LFS sale points, textiles, distribution network, and MBOs. So sale points are almost like the constant.
Okay. What I was trying to understand, your MBOs and distributor number which you give in your presentation for last 2-3 years, you just say 2,500 plus. So is that that is not a focus channel because if you are increasing your reach in other geographies and all, should that number not be monitored and going up?
Actually, we are closing some of our smaller MBOs because they are not able to survive because of the increasing competition, and we are increasing our presence in the larger MBOs. So some of the numbers actually have gone down, even though we have increased numbers in western and southern region. But some of the MBOs have closed down in the northern and eastern region, which were not able to compete with the larger MBOs. So that's another reason that it's almost constant in last 2 years. EBOs have improved. If you see the EBOs, it was last year it was 272 in September 19, but this year it has increased to 287. So we have opened 15 EBOs in last 1 year as compared to last year.
And in terms of, our online sales, still we seems to be very, very, sort of insignificant part of the overall, story. Whereas I think that channel, is the future and seems to be working very well for other brands and also, what's the plan on that?
We, again, I would say the same thing that we never dependent on the discounts around the year. If you see other brands, they have a policy where they keep on giving discounts even in the fresh season also, which we do not want to give. That is why the sales are little less in online sales. See, our intention is not only to increase our online sales, but to maintain our brand equity as well. We don't want to fool our customers to have a different pricing policy at all our channels. We just want to keep the same pricing at all the channels, just to make people purchase at any of the channels of the preferred choice. So that is the reason it has not grown as much as other brands have grown, but we are confident as the people are moving to fresh sales also in online, they are buying the fresh merchandise also. So in the coming 2-3 years, as Rishabh has rightly mentioned, we are on a track to achieve around 8 to 10% of total sales as online sales as compared to total sales.
So because see, many companies, I understand that totally that there's a pricing difference, but many companies have launched because there's a very different set of customers which goes online, which probably may not be available offline. And many customers, many companies have kind of addressed it through a very unique product line for online, apart from whatever they have, offline. And that's how they kind of balance between the pricing difference of offline and jo online may available hota that is not going to be available in offline. So are you on those lines, or it's just product line will be same with respect to the channel?
See, customer understands the pricing because when he goes to buy any brand, he has a certain price in his mind. I just cannot reduce the price for the online sweaters and keep the higher price at offline sweaters. That is not possible at all, because customer has a perception of a Monte Carlo brand to purchase a sweater at approximately, if you compare, around 3,500 rupees if he has in mind. So I just cannot reduce my brand equity and introduce something at a lesser price and make him purchase at the online sales. Our intention is just to make people aspire for the brand. So whether they go to any channel, so they should have the same pricing. They should have the same pricing point. And if they want to buy a brand which is like they have some aspiration in their mind, so they will go to any preferred channel of their choice and they will purchase it. You would like to add something? Mr. Rishabh will like to add something in this.
So I think, as you mentioned, like I also mentioned during my first answer, we are also working on these lines. We've produced some products exclusively for our online channel, but over there also we try to maintain the same discount that we are offering in the offline channels. So as Mr. Sandeep has rightly said, people have started buying products at full price now through the online channel, which was previously dependent only on discount sales. So if you see our first half of this year, the realization of our online channel has gone up by 6 to 7% in terms of MRP. So, and we've also shifted our focus to marketplace model, where all the products are kept in one specific warehouse and shown to all the portals, where we are able to minimize the inventory to achieve the desired sales. Also, I don't have the current geographical sale-wise value with me right now, but our sales in western area of the country has also gone up, and therefore we are tying up and opening up a warehouse in west of India also as of now. So going forward, I think the online, we'll be able to maintain the same discounts and grow at a better rate than the company as far as online is concerned.
Okay.
Thank you. The next question is from the line of Ridhima Chandak from Roha Asset Manager. Please go ahead.
Thank you for the opportunity, sir. So my question is on the EBO COCO operated and FOFO operated. So in FY18, our total EBO FOFO was approx 214, whereas in FY20 it is approx 241. And revenue contribution in FY18 was 35%, whereas in FY20 was 32%. So our store count is increasing in FOFO, whereas revenue is decreasing. And same in the EBO COCO, 21 stores in FY18, whereas 37 stores in FY20. And revenue contribution was just increased by 1% from 7% to 8%. So what is the reason behind that? And in the current year, we almost opened 6 stores, including some stores are shutting down and some are newly opened. So what is the strategy behind our EBO and what would be the SSG growth going forward after the COVID passes on? Currently, it may not be so good. So what is the strategy behind this?
See, I think if we compare the financial 18 and financial 19, definitely there have not been any growth as far as the EBOs are concerned. If I see like to like, we have grown only at 1% in case of EBOs because there have been slowdown in the economy. In the last quarter itself, we lost a sale of approximately 11 crores in that case because of the lockdown happened in various parts of the country. So I think going forward, we see even in this financial year, I don't think we'll have any growth in EBOs because we lost 4 precious months from April to almost August. We didn't have much sales, and the sales are just coming up. So, but the next financial year we are very confident because we are finding the opportunities which were available in the market, and we have opened 6 outlets also. So I think going forward, once we have this crisis is over, definitely demand will be more as compared to this financial year, and we intend to grow almost 15 to 20% as compared to this financial year in case of our next financial year EBO sales.
Okay. And you said that we will not do any capex in the current year. So is that also include that, like in the quarter 4 you just stated in that quarter was capex was approx 10 to 15 crores, which includes some debottlenecking and modernization, and it also includes some machinery for the mask manufacturing, which you imported from China, and the value was approx 3 to 3.5 crores. So what is the clarity on that part?
So you are right. We imported a few machines for making masks as it was a need of the hour at that point of time, and we also did a sale of around 2.1 CR in masks, and we also earned around 90 lakh of profit out of that sales. So that 3 to 3.5 CR was basically for a mask, and we also purchased a warehouse for our textile division, which we incurred around 9 CR. So the total capex in this year we projected was around 12 to 15 CR, and we'll land in that area only. But for the next 2 financial year, we don't see much capex, and we see in the line of the normal capex around 10 CR.
Okay. And so then on the this winter wear basically. So earlier some smaller brands were not able to produce, and there were some supply chain issues, and so this will give our company to chance to sell more in the city, like especially Ludhiana. So what is the current current status of the supply and demand specifically for the winter and for the overall our company's portfolio?
See, as we have seen that there have been lockdown and the production could not be started before July itself. Workers had gone back to their homes, so by the time they came back and the production started and everything is normalized, we were almost in mid-June and end June. So I think it's same for everyone in Ludhiana. If we see the smaller hosieries as well, even everyone, they have cut down their production around 40 to 50%. But fortunately, in case of Monte Carlo, I think we'll be reaching around 80 to 85% of our sweater production as we did in last year. So that is a great achievement, as we have been able to do it in spite of we have lesser workers, in spite that there have been a lot of issues in transportation and logistics, but we have been able to maintain our production. Even in case of our outsourced production also, we'll be reaching around 75 to 80% of the levels, which I think industry, as far as Ludhiana is concerned, will be doing only 55 to 60%. So we are better placed as far as production levels are concerned as compared to Ludhiana industry, but definitely we are less 20 to 25% as compared to last year's level, as there have been disruptions in the production in the initial 2-3 months. But we are hopeful, as the guidance we have given in the beginning of the year, we'll be doing around 75 to 80% of the sales, which we did in last financial year, despite all the disruptions we have faced in productions and deals. And one good thing, I think, which I would like to share is that because the supply side is now having the constraints, but the demand is actually coming up in this festive season, as the wedding season have also started. So we hope to have a lesser stock in our warehouses by the end of December this financial year as compared to, I would say, that financial year, because of the less production. But the demand is actually in October has come up, and in November we have seen it is picking up. But everything depends on definitely how we have the next 15 to 20 days as far as the second wave of corona is concerned. Right now it seems very positive. We are confident in Ludhiana and in Punjab, in various other states where we are operating. We are not seeing much crisis as far as COVID is concerned. But you never know, as no one was expecting in Europe and US also, and it has hit them very badly. But if the phenomena keeps on going like as of today, we will have almost better margins, I would say, as compared to last financial year in this quarter.
Okay. So on this woolen side, so in the first half we almost clocked almost 11, and our revenue contribution was approx 11.9%, right? So I assume that as you stated, guidance of 75 to 80%, but I assume more than that, almost to the 100% or more. Why? Because our FY20 contribution was approx 22.3%, right? So and in terms of our value, FY20 in terms of our volume, FY20 volume was approx nearly to 12 lakh pieces. So what is currently side like in terms of volume and yeah.
I think the volume will drop by 15 to 20% as compared to last year's level, and it would be around 25% in case of cotton segment. So in the woolen, the drop will be lesser, but in the cotton segment, it will be more. So the volume drop overall, we see around 20% of total financial year.
Okay. And just one last question. On our cost side, what would be our advertising cost negotiation? Like they say you save almost 15 crores in the last quarter, almost in quarter 4 or quarter 1. So what would be the guidance for the advertising and salary cuts? And also there are some earlier there were some delayed payments from some of our vendors. So is there any default, and you also gave some credit for the 2 to 3 months? So any clarity on that? Yeah, that's it from me.
I think the advertising will be saving a lot in this financial year. There are 2 reasons for that. We used to hold trade shows for our retail bookings twice in a year, where we used to spend almost around 4.5 CR to 5 CR expense, but that has been cut down, and we are doing virtual booking and door-to-door booking. So that expense actually have come down a lot. And so that was one part for business promotion expenses. And secondly, advertisement expense, which was around 3 to 4% last year, will come down to 1 to 2% because we are reducing our dependence on hoardings and also on some of the print media, but we are increasing our spend on digital and social media spend, where people are hooking up these days as and when the lockdown has started. So definitely there will be a reduction in the advertisement expense. In the percentage terms, we expect it to be around 1 to 2% of total revenues in this financial year, as compared to 3 to 4% of last year's revenues.
Okay. And some delayed payments as you were given some credit of 2 to 3 months. So what is the status on that side?
See, the payment position has actually improved as compared to last year. So we have put a lot of focus on the recovery of payments rather than promoting the sales. So that has helped, like improving our working capital also. At the same time, the debt has also gone down.
Okay. Just one last question on our home textile portfolio, which contributed significantly during the quarter. So, and on our MC Healthcare, what would be our long-term lookout on these two segments? How much revenue contribution we are expecting to contribute in our total portfolio from these two, as we invested also in the healthcare segment? Yeah.
Okay, first we'll come to home textiles. Home textile contributed almost, I think, around 12% in last financial year. But this year, I think the contribution from the home textile should be around 18 to 20% of the total sales, because home textile sales is not decreasing, but the overall sales have decreased. So the home textile contribution will improve to around 18 to 20%. And now if I come to healthcare, see healthcare, the sales depends on definitely the COVID crisis, because the demand of masks actually have gone down as compared to last quarter. And everyone is actually manufacturing masks now. In almost 800 machines have come up in India in last 2 months. So the price have considerably reduced and the demand has also gone down a lot. So I'm not very optimistic about the healthcare division, and we expect lesser sales in this quarter as compared to last quarter, unless and until, which I don't want that the COVID cases goes up, which is not in our interest and your interest as well. So, but we see that the healthcare division should have very lesser sales as compared to last quarter because of very less demand in masks now.
Okay. Thank you so much, sir.
Thank you. The next question is from the line of Deepan Shankar from Trust Lines. Please go ahead.
Good afternoon, sir. Thanks a lot for the opportunity. First of all, I just wanted to understand what are the key drivers behind this gross margin improvement of 600 bits to 60.5% kind of margins.
See, the reason being is the cut down in the expenditures. So we have cut down on the, if you see in the presentation, we have cut down on the advertising, we have cut down on the even salary part, we have cut down on the other expenses as well. So all these things, I think, have helped us to improve the gross margins.
On the raw material side, sir, I'm asking on the raw material. So the raw material cost has come down as compared to sales. Even though our cotton sales and also winter sales has come down drastically over year on year. So still we have seen some gross margin improvement, sir. Not on EBITDA margin, but on gross margin.
The gross margin have improved, you have rightly said, because of cotton sales going down. Because in woolens we have higher gross margins. And so the cotton sales have actually gone down in this quarter, and the woolen sales have actually gone up proportionately as compared to last quarter. So that is why the gross margins have improved.
Okay. And also higher inventories, so at 313 crores. So this is mainly to cater to Q3 sales itself, or something else we are stocking up?
No, the higher inventory reason is that we have not been able to sell our complete summer inventory in this financial year. We have to hold our summer inventory. So in that case, the inventory has gone up in case of summers. In winter, it is almost same.
Okay. So do we foresee any inventory write-off for the summer season sale?
Not at all, because what we did is that we have saved some of our inventory to be relaunched in the next summers. It's basically which will be in this financial year. In winter also it has gone, because there were some shirts, trousers and denims which we didn't sell in summers. So they are going in September and October this financial year, because we have to hold the inventory as the lockdown has happened. So some of the inventory has been held up. So but we don't see any write down in any inventory, even in winter as in summers also.
Okay. Thanks a lot and all.
Thank you. The next question is from the line of Apurv Mehta from EM Investment. Please go ahead.
Yes, sir. Just wanted to ask that, when you were talking that the overall productivity of the women is, overall less. So, going ahead, we will see less discounting of the products because, normally Q4 we have to discount it heavily and sell our products. So, can we assume that the discounting will be much lesser and we will having less inventory also for that?
Yes. We will have, I think, if we compare to the last season, we should have a less discounting because the merchandise available with us is not that much. So I think we will have more sales at the lesser stock available in the store, which will improve our fresh sales. And secondly, because the production is less as compared to last year, and as I have clearly told you that the volume is almost 20% less as compared to last year. So there will be less in inventory at the store level at the end of this financial year. We are very confident about that.
So that will help us to improve our margins substantially because we are not going to have more of advertising expense or, lot of cost cutting is there. So, and the discounting will not be there. And we will have some improvement on the realization also. So, if we thought we reach 90% of sales, but the margins will go up, maybe 200, 300 bits.
See, it's because the sales are down 20%. So the best thing, I think, what we are doing right now is that we are curtailing our expenditure in all the areas. So our intention is to maintain or better the margins as compared to last year. But definitely when the sales is down, it affects the margins as well.
So, but Q3 will be definitely, seeing will be far better than, you must be envisaging far better sales and margins in Q3.
See, right now it appears that the Q3 should be better as of now. But again, I have told you that there are uncertainties in the market about the COVID and all. If it doesn't hit us badly in the second wave, then I don't think that we should be doing better as compared to second quarter as well as compared to last quarter of last financial year also.
And going forward, when we were talking about marketing and advertising expense and, your trade shows and everything, do you think this will be a structural shift on that side that we will be doing more of, marketing expense on the online and on the social media and there will be a virtual trade shows which will help us to cut down costs. Is there structural shift which can happen? Do you think so?
Would like to answer? See, as we are seeing that after the lockdown, people are looking more on the social medias and the digital channels. So intentionally, we have increased our spend on the digital media and social media. And I think this trend will continue for this financial year. And we'll see as we go ahead how to keep this trend in the next financial year. If we see that there have been more response in the digital media and social media, we'll definitely keep on increasing our spend in this and reducing our spend on other channels.
Okay. Because and one more question, lastly, when we were looking at a lot of companies, their focus was on the EBO sites. So are we also looking at that because a lot of companies have started, focusing on more and more kind of EBOs and, expanding their EBO presence. So do you see that?
The question, your voice is not clear at all.
No, a lot of things that we were looking at that people have started, focusing on the EBO channels. A lot of brands were started shifting on the EBO channels. So are we seeing that, our company also focusing on EBOs more of a kind?
You see, we are focusing definitely on the EBOs because there have been some issues with the MBO channels as the smaller MBOs are not able to compete with the larger MBOs as well as they are not able to cut down their expenditure because they don't have much incomes also. So I think to grow in some of the regions, we need to open more EBOs so that we can have the potential which is available in that particular area. So that is why 6 EBOs have been opened in last 2 months also, and we have a plan to open another 7 to 8 EBOs in next 3 to 4 months.
Because, what I was learning is that a lot of companies are going very aggressively on the EBOs, like they are adding 50, 100 EBOs a quarter kind of thing. Okay.
We are not in quarter. We are not so aggressive.
See,
Yes.
basically, we are a company which want to complement all our channels rather to compete all our channels. So we don't want that my LFS should compete with my MBO, my MBO should compete with EBO. So we open the EBO where we see there has been decreasing sales in MBOs or there are no MBOs. We open our MBOs where we see that the EBOs we cannot open. So we would like all our channels to complement each other rather than compete with each other. Otherwise, it will hurt the overall brand sales.
Okay.
Yeah.
Okay. Thanks a lot, and wish you all the best.
Yes. Thank you.
Thank you. The next question is from the line of Venkat Subramaniam from Organic Capital. Please go ahead.
Hi. The gist of my previous questions as well were just directed at this. We are wondering whether there's been a structural disruption in the apparel game altogether. But from all the discussions that we have heard, you don't seem to perceive that. Does that then mean that some of the aspirational guidances that we gave, which is like, getting to 1,000 crores in about a couple of years, growing 15% top line, retaining about 11.5% kind of pre-tax profit margins, etc., you think none of them are threatened and you think we are on course?
See, I think we were pretty much on course before this crisis happened, because we have been, if you see, in the last financial year also, we have grown almost 14% in spite of the economic slowing down, in spite of the GDP growth has come down to 4 to 5%. So I think in this financial year, it is definitely something which has never been seen by anyone. And because of COVID, we are reducing again, our guidance to 75% of last year's sales, which was because of less production, because of no manufacturing happened in from April to almost June. But I don't see any deviation as far as our target of growing around 10 to 15% every year. We are on a course to achieve that guidance. And I would say that in the next financial year, definitely the growth would be much more, because almost the sales will be down by 25%. We already achieved 725 crore in financial 20. So you can assume that the growth of next financial year should be much more, as the economy will be opened up, and we are in a good position because we have cut down our expenses. Some of the advantages we will get from the lockdown is that we have cut down our expenses, which is going to continue for us. That should help us in improving our margins. And there are some other things which we learned in this particular period, which was not there in last financial year. So that would help us. And we are better placed as compared to other brands, because we were not that much affected, as we were dependent mostly on the third quarter. So in the third quarter, still we'll be doing better as compared to other brands who were affected in the first and second quarter as well. So I think Monte Carlo is better placed to achieve the guidance which we have given 2 years back. And again, it depends everything on the how this crisis ends and how this country's economy grows up in next 2 to 3 financial years, and how the policies of the government shapes up in coming times. But we are confident about it.
No, Sandeep, my question is not with respect to what happened before. Post-COVID, we are wondering whether we are actually looking at a completely new world, and with respect to how branded apparels will get consumed or will get sold or bought. So in that context, are we still rewiring ourselves, or is there a need to do that, or the existing strategies are good enough to get us there?
I think Rishabh has clearly mentioned that our focus is shifting to online, because after lockdown, people have actually developed the habit of purchasing online, which was not there earlier. Earlier it was some of the population which was going online, but now I think almost 70 to 80% of the people have gone online and purchased the things. So we are shifting our focus, definitely restructuring ourselves to make available on all the websites which are there in India, as well as our own website. So that is one change which the company has done. And secondly, we have seen that the trend of clothing is also changing. People are looking more at casual clothing. Once the lockdown started, we see the active wear, the leather wear range have picked up. So we are putting much focus on those kind of apparels also, which can help people to stay at home, and work from home. The culture is coming up. So I think there have been some changes which have been made by our design department as well. There are some changes which have been made by our marketing department, how to control by sitting at one place to all the outlets everywhere in India we have. And thirdly, again, the shifting of our focus on the online channels where the sales are picking up. So these things will definitely help us in growing our sales in next, I think, 2-3 financial years.
Thanks a lot, sir. Thanks.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
So thank you everyone, and I think if we have answered all your queries, but still if any queries unanswered, so you can definitely mail us to our company secretary and our finance controller, and I wish you all a very happy and a prosperous Diwali. Thank you very much.
Thank you. On behalf of MK Global Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.